Today we're going to go over some questions from chapter 5 and chapter 6 so you can get some more understanding. And just to remind you about the purchases and the sales, and then we're going to do some closing entries for the periodic system. And then we're going to do some calculation for the ending balance and cost of goods sold under periodic and perpetual for first in, first out calculation, weighted average calculation. So let's start with the first question here, which is for each of those scenarios, we have to calculate cost of goods sold. That's a very simple question. There is nothing scary here, as you can see. Let's move to Excel spreadsheet. And let's do this on the Excel spreadsheet. So what the question asks is, which is the situation we have to calculate cost of goods sold? How are we going to get cost of goods sold? Cost of goods sold, first we have to check the information. In this information, we can see that we have inventory, we have the purchase account, and we have a physical account on the end. So technically, this company is using periodic system. Since first they have the purchase account, which directly gives you idea that they're using the purchases as a separate account, and inventory, they're not putting everything in the inventory. So for that reason, we have to do the following calculation. We're going to start with the beginning balance of the inventory. Then we're going to add, let me change this font. We're going to start with the beginning with balance of the inventory. Then we're going to add the purchases. Then we're going to see how much we have available. Then we're going to deduct ending balance of the inventory, the one that we count, and then we're going to see how much is the cost of goods sold. That's what we have to do in both scenarios. So first, in the first case, our inventory, beginning balance of the inventory was 170. Once we add the purchases of 700, we're going to have available for sale 870. And once we deduct the ending balance of the inventory, which is 120 on hand, which we count, our cost of goods sold will be $750. That's for the scenario 1. If we have to do the scenario 2, the situation will be exactly the same. In the beginning inventory, we're going to have 200, and then we're going to add the purchases, which is 1000. And now we have available 1200. Once we deduct the ending balance, which is 75, we're going to see how much is our cost of goods sold. So that's what we're going to do today. We're going to focus on later a little bit. We're going to focus on calculation of the ending balance and cost of goods sold. As you can see, available, what we have as available is equal to ending inventory plus cost of goods sold. So always remember, cost of goods sold and ending inventory has to give you the available for sale, which we have as a beginning balance and the purchases. Then we're going to build on this today with the different questions. So now let's move to question 2, which for question 2 is now we're going to start looking about the purchases. For question 2, obviously that's not going to be the one, and I'm going to post it, make a new posting as a picture. We have this question. Let me clear this space now, And we have this question, which is this company using the perpetual inventory system, which makes our life way easier. Why? Because in the perpetual inventory system, we already know that everything goes to inventory account, including the freight, goes to the inventory account directly. What we have to do, we have to just generalize what happened in this company. I'll make it a little bit bigger here for the journal entries. And let's start going one after another. First, we're going to have May first, and we're going to have our journal entry here, which will be the May 1st. We purchase merchandising inventory on the terms 1% within 10 days if we pay, nothing if we have to pay within 30 days. So in the beginning, we're going to have debit inventory. And we're going to debit that inventory with right here. I'm going to use this column here, $1,200. And then we're going to credit. We're not paying. We're just purchasing the inventory on account. And we're going to create accounts payable for the same one, $1,200. Great, we have our first entry. Next one. Then we're going to the May 14th. And on May 14th, we're paying for the purchase on May 1st. The question is, can we use the 1% discount that was given to us if we pay within 10 days? Since we're paying within more than 10 days, we cannot use that discount. So for that reason, we have to pay exactly the amount that's sitting outstanding as accounts payable. So we're going to debit accounts payable with $1,200 and we're going to credit cash for the same amount. And we're done with the second entry. The third entry on May 15th, they keep purchasing. And in this case, we're going to purchase debit. We're going to get inventory. And again, we're not going to pay. Credit. Accounts payable. The inventory in this case is $3,000. The terms are 215 and 0. Now we're paying on May 30th. Now May 30th in this case is within the 15 days. So now we can use the discount. But we're using the discount only for the payment. So first we're going to clear the accounts payable because once we make that payment, the $3,000 are gone, accounts payable. Now the cash that we're going to pay will be less. Cash will be, we're not going to pay $3,000. We're going to pay $3,000 less 2%. $3,000 and we're going to deduct 2%. So it's going to be $3,000 times the 2%, that's going to give us exactly $60. So we're going to pay $3,000 less $60, so our payment will be $2,940. That's our payment. What we're going to do with the difference now, we have to credit it somewhere. When we're going to credit to the account, which is called inventory. Remember, we are on the perpetual inventory system, so everything goes to the inventory. How much will be that? 60. So in that case, as you can see, if I eliminate those two entries, Let's go with this elimination. If I eliminate those two entries, let's pretend for a second I don't have those two entries. I have debit inventory, credit cash for the same amount. So I'm using accounts payable as a temporary account just to show that for the meantime I haven't paid for the inventory and later on I paid it. But if I eliminate it again, I'm going back to the debit inventory credit cash for the same amount. Now in the second scenario, like when they eliminate accounts payable, what's going to happen? Now my inventory account will be equal to the cash because $3,000 inventory minus the $60,000 going on the credit side of the inventory is going to decrease the value of inventory to 2,940, which is exactly the cash that we pay. Now let's put this question. No, I'm going to leave this question here, and I'm going to put this all this chart, and one of just going to give them more presentation like this, and we have here debit, and we have here credit, and we have our chart. Okay, that's with question 2. Let's move to question 3 now. For question 3 now I can use the build up that I have from question 2. And I'm going to delete this one. So what's going to happen in question 3? On question 3, we're going to have the purchase allowance. No, that's not purchase allowance. We're going to have inventory that we're going to return. Oh, this is our question. So this company, what's happened with this company? Again, they're purchasing inventory, and they have that perpetual inventory system. And delete all of those, and including this one. So what we're going to do here? We have to journalize each transaction, assuming that perpetual inventory is used. Let's start first. On August 2nd, what's happened on August 2nd? We purchase inventory, so debit inventory, and we purchased the inventory for $14,000. If we pay within 5 days, we're going to get 1% discount. Within 50 days, we have to pay without any discount. And we're going to credit accounts payable again, $1,400, $14,000. Then we're going to receive a memorandum from the supplier confirming that $1,500 allowance regarding the August 2nd purchase. So what that means? That means some of the items that we received on August 2nd was broken or we didn't like them, so we ship them back. And once we ship them back, the people issue a credit memorandum, so we don't have to pay for those items. So let's do that. On August 4th, now if we don't have to pay for those items, that means we can reduce our accounts receivables. So accounts payables. Debit accounts payables for $1,500 and credit, since we don't have the items, we ship them back, credit inventory with the same amount, $1,500. On August 17, we pay for everything. But we have to deduct the allowance that we receive from the vendor, in this case, or from the supplier. So let's do it on August 17 here. We're gonna do debit accounts payable. Now let's see how much we have to pay. We have to pay 14,000 minus 1,500, so that means $12,500, and we're paying it. Credit is gonna be cash. $12,500. And we're done. In this case, there's no discounts, nothing like that. Just simple return. But as we said in the perpetual inventory system, everything is going to go to the inventory account. Now let's go to the next question, which is question number 4. On question number 4, we have to do some additional things, pretty much the same, but just a little swing in additional stuff. What will be that? That will be this company is going to have in this case, they're gonna pay within the terms, credit terms. So let's see how this is gonna work. Again, I'm gonna delete this and we're gonna start again. First, on March 5th, we purchase 500 units of product with the list price $5 per unit. The purchasers was granted a trade discount of 20% in the terms of sales of $2. 2% within 10 days, nothing within 60 days. So how are we going to deal with this? First, we have to find out what's our purchase price. For the purchase price, if the person give us 20%, now we have to see how much is the total. We have 500 units, and we're paying $5 per unit. So in total, our total cost is gonna be this one time $5, $2,500. But we're getting a trade discount of $500. So on the time of the purchase, we're not gonna pay those $500. So how much will be that? We're gonna apply the 20% and we see how much is the 20% discount that we're gonna get. 2,500 times the 20% discount. The discount's gonna be $500. So what we're gonna do, debit inventory. And the inventory is gonna be only $2,000, or it's gonna be equal to 2,500 minus the discount 20%, $2,000, and we're not paying it. Credit accounts payable with $2,000. Next transaction is gonna be on March 7th. We're gonna return some of the inventory, defective 50 of the units defective, which we purchased on May 5th. And we're gonna receive the credit for the same. So we're gonna get 50 units of those. Now, as you remember, the cost is $5 per unit, but we're getting 20% discount. Don't forget that. So how much will be that without the, now we have to get the total. Total will be 50 times 5. Gonna be 250, but the 20% that we already took is gonna be this one times the 20%. So the goods that we return and for which we don't have to pay, the total value is $200. And here is gonna be this one minus that one. And this case is gonna be 200 minus the $50, 250, that's $200. So those are the amounts that we dealing with. So now we have to reduce our accounts payable, since we're not going to pay for the items that we returned. So that will be debit accounts payable with $200 and credit inventory with $200. So at this point, our inventory is $1,800 on value. Then we're going to the March 15th, and we're paying. From March 5th to March 15th, that's exactly 10 days. So now we can take advantage of the 2% discount. How much will be that? 2% discount. So first, let's see how much we have to pay. We have $2,000 accounts payable minus 200. So we pay $1,800. We're going to take the 2%, and the 2% is going to give us a reduction of $36. In total, our cash has to be $1,764. That's how much we're going to pay. But once we pay it, we're done with accounts payable. So we have to debit accounts payable with 1,800. And as you can see now, those 200 debit and 1,800 is exactly 2,000, which clear our accounts payable in the very first place. Then we're going to pay the cash. And we're paying 1,800 less the 2% discount, which we're allowed to take. 1,764. And where the difference is gonna go? The difference is gonna go to inventory. In inventory account, we're gonna balance that journal entry with $36, and now we're in balance. And that's our purchases. There's, as you can see, there's nothing scary on the purchases for the perpetual system. Now, for the periodic, if we have to do the same entries, if we have to do the same questions for the periodic system, what will be the difference? Every time when we have a discount, we have to go to the purchase discount account instead of inventory. Every time when we have the return, instead of going to inventory, we have to go to create purchase return allowances. That will be the only difference. So if you want, let's do this question. In this question, we have the return and we have the discount. And let's use this question, the same calculation, and let's make it instead of perpetual to make it periodic system. That will be question 5. And let me change a little bit in this question. And now we become question 5. Almost there. Just give me 1 second and I'll be right with you with question 5. I'm just creating it right now. Here we go, done. And let's eliminate this question and let's paste here question 5 now. Again, same scenario. The only thing is now we're assuming that this is periodic inventory system. What's going to change? Again, on the dates, not going to change. No much changes. Only on the accounts. So let's go with the accounts. First, Again, we're gonna purchase the same 500 units at list price, $5, but they're gonna give us a 20% discount at the time of the purchase, so we don't have to calculate the purchases indirectly. We're gonna debit our inventory account with $2,000, and then we're gonna credit. Actually, we're not gonna debit the inventory account. Inventory account's gonna stay as an inventory account. In the periodic system, we're gonna debit the purchases. We're gonna debit purchases account, and purchases account later we're gonna close it, and credit's gonna go to accounts payable with $2,000. Now, when we do the return, we're gonna have debit accounts payable. We're gonna reduce the accounts payable with $200, and we're gonna have a new account here, which is the purchase, return, and allowances. That will be our new account now. Let me deal with this. Something is very, very, very wrong. Okay, purchase return and allowances. It's still not what I want it to be, but we're getting there. There we go. $200. Once we do this, on May 15, now we're gonna start paying. We're still gonna pay 1,764, and we're still gonna close the debit accounts payable with 1,800. But now cash is gonna stay the cash. Credit is gonna stay cash. 1,764. But now the $36, they're gonna go to new account, which is debit. That would be credit. Purchase discount. And that's how we're gonna make the difference between the periodic and perpetual system. As you can see, in perpetual, everything goes to inventory. In periodic, we're using purchases for the purchases, purchase return allowances for the return allowances, and purchase discount for the early payment discount. That's for the purchases. Now let's see what's gonna happen once we start doing sales. Gonna keep going with this setup of the question. I'm not sure. I'm not sure if you're following the Microsoft and development of Microsoft that doing on the Excel and the Word document, but what I found it is the newest version of Microsoft is way worse than the oldest version. I don't know what they're trying to do. Try to people give up using Word and Excel, or what exactly their new direction is, but it's getting more and more complicated and giving some mistakes that I don't understand anymore. So let's go now to the question which is gonna deal with sales and sales only. Now we're moving to the other side of the merchandising business. We're not on the purchases anymore. We're moving to sales. First, we're gonna do some sales on the perpetual system. Sorry, not yes, perpetual system. First, What's the difference? Now, before we start doing those journal entry, what's the difference between perpetual and periodic system? In the perpetual system, since we can calculate cost of goods sold instantly at the time of the sale, we're gonna do the two journal entries on time of sale. One will be for the sale, and the other one is for the cost of goods sold. Why for the cost of goods sold? Because we always want to see how much is our gross margin. In the periodic system, we won't be able to do that. So what we're going to do in the periodic system, we have to wait to the end of the period, count the ending inventory, and come up with the calculation for the ending inventory and cost of goods sold. So let's start with this question. On September 1st, what we did, we sold merchandising to this company with cost of sales $4,200. Now they have a terms for discount. If they want, they can take a discount. If they pay within 10 days, they can deduct 2% of the outstanding amount. So let's go. Debit. Since we're doing the sales and we're not getting cash, we're getting accounts receivables. And credit's gonna go with sales. Debit will be $6,000 and credit will be $6,000. That's the amount of our sales and accounts receivable that we're waiting. Now there's a second entry on September 1st to show the debit cost of goods sold. And credit, we're gonna reduce the inventory because once we sell it, we don't have it anymore. But I cannot use at this point, and it's not the right thing to do, is to use the selling price and have to use the cost. Because if I already know that my sales are $6,000, I already know that. Now what I'm trying to find out is how much is my cost of goods sold. Because once I found how much is my cost of goods sold, I can easily calculate how much is my gross margin. And once I get my gross margin, I can calculate it as a percentage. Right now, percentage is zero, nothing. I'm not making anything. Why? I'm selling, but I don't know how much is the cost. And this inventory comes with the cost. So the cost of goods sold in our case, 4,200 and 4,200. So when I plug here $4,200 and I calculate the gross margin, which is the sales minus cost of goods sold, I'm seeing that my markup for the goods that I'm selling is 30%. Now let's do the second entry, which is for on September 14. On September 14, what's happened on September 14? We collect whatever we couldn't collect on September 1st. So debit, cash, finally some cash coming, which is $6,000, and we closing the accounts receivable. Credit will be accounts receivable, which we're creating on September 1st since the client paid the entire amount. Now you're gonna ask me, are we gonna use the percentage? No, because the client pay more than 10 days after the sale in this case. So for that reason, no discount. Let's add some more space here and let's keep going with the next one. Then on the September 15, we're doing the sale, another sale. Now this time the cost of goods sold is 1,500 and the sales is 1,800. So if you have to do this calculation again, let's make this one reading from here and this one reading from cost of goods sold. Okay, so we're gonna do the same thing. Debit, since we're not getting cash, accounts receivable for $1,800. That's how much we're selling it. we sold merchandising with cost factor for 1,800. So 1,800 is the amount that we're selling. And credit sales revenue. And our sales revenue is $1,800. So this number here is $1,800. Now what we have to find out, how much the cost of goods sold. Well, they're coming with the cost 1,500. So that will be debit cost of goods sold, $1,500, and credit's gonna go to inventory. Why inventory? Because we sold our inventory. We don't have it anymore. It went to the client. So the cost of goods sold here will be $1,500. So as you can see in these cells, we're not generating our regular 30%. If we say 30% regular markup, we're generating now only 17%. Next thing that we need to do, I need to copy this and extend the format. And then we can see what's happened on September 25th. On September 25th, client decided to pay. Let's see how much cash we're gonna get. If he pay within 10 days, which he pays for within 10 days, he can deduct 2% discount. Now, how much is the accounts receivables? Accounts receivables at this point is sitting at $1,800. If he apply 2% discount, how much he can deduct? That will be equal to 1,800 times 2%, that's gonna be $36. So the cash that we're gonna see is not gonna be $1,800, it's gonna be less than that. Or it's gonna be $1,764. Somehow this amount is very, very familiar, which coming from the for the purchases, if you remember. So debit cash will be 1,764. Now credit, I'm gonna credit accounts receivables because I have to close the 1,800 accounts receivables. But now I have shortage on the debit side. So on the debit side, I'm gonna debit account which is called sales discount. For how much? For $36. Now I'm in balance. That's why we have sales with cost of goods sold and with a discount. Now let's see what's going to happen when we have when the client returns. That will be question 7 in our. So let's copy this question and let's move back to the Excel spreadsheet where you're waiting for me. Okay, let's go with this. Seeing now that you're posting some questions. Unfortunately, I'm not monitoring right now the chat, but I'm gonna go back to the chat in a second. Let's finish this question here with the cells. Is it great job, Yuriko? Thank you. Shada, is Yuriko explanation solve the problem? Thank you, Rico. I'll owe you now. Okay, let's go with this question now. New question. Delete all the information, start again. And the months, we don't need the months. Let's go again. First, on October 15th, what we're gonna do? We're gonna sell merchandises for $900, which have original cost of $600. The terms is 1/5, so it means if the client pay within 5 days, we're gonna give him 1% discount. And 20, that means after 5 days, nothing, up to 20 days. Up to 20 days, the purchase is due. What's gonna happen after 20 days? Most likely we're gonna charge him interest, or we're gonna start begging him to pay us those $900. So let's go with the first one. Debit will be accounts receivables because we're doing sales, we're not collecting. And that will be for $900. Credit's gonna go to sales revenue with $900. I have my sales. What I'm missing? My cost of goods sold. Let's get the cost of goods sold. Debit. Cost of goods sold, which is cost of goods sold is $600. And what we're gonna do? We're gonna credit inventory account with the $600. So I can see my markup is 333%. So at this point, what I'm gonna do is let's do the same thing that we did last Monday. I'm gonna save this worksheet here somewhere and here, and that will be chapter 6 calculation. July 06, 2026. And what I'm gonna do is I'm gonna share it with you. I'm gonna post to this file here, and you can have it. Because it's currently in use. Okay, I have to stop using it. Just give me a second. I have to stop sharing first. Move to the Word document, close the Excel spreadsheet that I was creating. And now I can share it with you. Let's do the same thing here. And now you can have the file. So now instead of just sitting and watching, you can start doing the journal entries with me. Remember last time you told me that this is way more interesting than just sitting and watching. So let's stop sharing this and let's share the screen that I have with the same Excel spreadsheet now that you have. We both have the same Excel spreadsheet and we're both on the same stage that I am. So let's see the next one. On October 16th, now, we're gonna issue $100 credit memorandum regarding an allowance on October 15th sale. Credit memorandum. Okay, we're gonna issue that credit memorandum. What we're gonna do? We're gonna do debit sales return and allowances return and allowances. And we're gonna credit accounts receivables. Now the client doesn't have to pay for those $100. Make sense? So now next thing that we're gonna happen is, as you can see here, we're giving allowance. That's not return. So what that means, the client doesn't have to return the inventory. So for the allowance, we're just reducing the accounts receivables. We debit in the return allowances. No, this is not discount. Discount is only when the client pays short amount than what he's supposed to pay. That's a discount. Allowance is, remember the scenario from last week? For example, let's say I'm purchasing something. What I'm purchasing. Something, 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 something. Let me see what I can purchase. There's something in front of me. Cups, mugs. But one of the mug, when it says here Starbucks, there's a little bit kind of scratch on the cup. Can you see the cup here? And imagine there's just a little bit scratch here. I'm okay with that because I can sell it to my customers, but I want them to give me allowance for that scratch. And they say, okay, if I give you allowance, would you keep the item? And I say, okay, I can consider, yeah, I might be able to keep it, yeah. Then in that case, keep it, don't return it, and I give you allowance for $100 for which you don't have to pay. That's allowance. Now, next thing comes. Next thing that comes is the October 25th. Now our terms is within 5 days 1%. Is this company follow that term? Obviously not. They're above that. So we're not gonna calculate any percentages here, so I can easily delete those cells. So then what we're gonna expect? We're gonna expect to see in our account $800. Why? Because our accounts receivables is $800. 900 minus 100 allowance. We expect to see debit cash of $800, and that's gonna close the credit accounts receivables with $800. $800 cash that we receive with accounts receivable 900 debit and 900 now we have on credit, accounts receivable is closed. Let's go with the last question here for the cells. Again, the only thing that you have to do is control and flip the worksheet and it's gonna work again, or you just double it. Copy and paste it. Let me grab the question 3 here. And show it to you as a picture again. Now, post it here and gonna stretch it a little bit. Now you don't have this one, correct? Let me clear this one and close it and send it to you. Now you can start working. chat, and where are you on the chat? And file, I'm gonna share the same file like before, and boom, and now you have it. Let's start working now with this. And that will be exactly where I left you. Correct? So let's go now. First, we have journal entry on April 1st. On April 1st, what's happened? We're selling the merchandising for $2,000, and we're granting the customer terms of 2% discount if the customer pays within 10 days. The cost of the merchandise is $1,400. So let's go. Debit accounts receivables with $2,000. Credit is gonna be sales revenue with $2,000. Boom, I have my sales. Next thing what I need to find out and record the cost of goods sold. On April 1st, actually I don't have to because continuation debit cost of goods sold is $1,400. As you can see now, your calculation for the cost of goods sold and the gross margin is 600, so we have markup of 30%. And credit inventory with $1,400. Okay, this one's done. Let's see now, the previous scenario was with allowance, now we have a return. In this case, the customer didn't like some of the items. Now he didn't like the fact that the cup has that little defect, so he want to send it back. And we say, okay, we're gonna get it back. On April, now 4th, what's gonna happen? First, we have to show that he doesn't have to pay for this. And we have to give them a debit sales return and allowance. And we're gonna give him that return allowance for $500. Credit, in this case, will be accounts receivable. He doesn't have to pay for $500. Next thing, that inventory that he returns is gonna come back to us. So we have to increase our inventory again. And the inventory is gonna be 350. And credit, now we have to reduce our cost of goods sold. Cost of goods sold with $350. Now let's see what's happened with our calculation here, where we are after this return. Originally, we have 2,000 sales, but now our sales are not 2,000. Now our sales become 2,000 minus 500, the return, so net sales. So I have to change here abbreviation, have to put it net sales, 1,500. Cost of goods sold, first was 1,400 minus 3,500, 350, and that's gonna give us, and doesn't give me anything. The Excel stuck for me. I don't know how it's for you, but this is what I'm talking about, that Excel stuck sometimes. So what I have to do, I have to save it, close it, open it, and start again. And as you can see, after the return, we're still achieving 30% gross margin, but now our sales reduced with $500 and cost of goods sold reduced with $350. Our gross margin went to $450, but we're still on 30% gross margin. Now, the last thing that's going to happen is on April 11, the company is gonna pay us But since they're paying within 10 days, they're gonna enjoy discount of 2%. So how much is the accounts receivable that they have to pay? So the first was 2,000 minus 500. So accounts receivable is 1,500. 2% that they're gonna get is gonna be equal to 1,500 times the 2%, $30. So in reality, how much we're gonna see cash? We're gonna see cash of minus $30. 1,470 is the only cash that we're gonna see. So let's go debit cash with 1,470. We have to close the accounts receivables because we're not gonna chase this client to pay us later $30. So 1,500 accounts receivable gone. Now accounts receivable 500 here, 1,500, clearing this 2,000. We're done. And the last thing that left is we're short on the debit side, so we have to debit sales discount in this case. Now where does that sales discount gonna go? That's $30. That's gonna go in our calculation here. So after the sales discount, let's see what's happened with our calculation. Now we're gonna have net sales of 2,000 minus 500 return allowances minus discount. So our sales are 1,470, which is exactly matching the cash that we receive from the client. Cost of goods sold is gonna be 1,400 minus 350, or it's gonna be still 1,050, but our gross margin, as you can see, now reduced with 1%. Why? Because we give it as a discount to the client. And that's with this purchases and sales. Now let's do this thing, this calculation, or this type of question, when we having the periodic system. Question 9 here. Just give me a second to change the question in the Word document and I'll be right with you. I'm gonna use exactly the same scenario, I just gonna change the question. Periodic inventory system. Let me add some more information because I need to add some more information, otherwise we won't be able to do the things. Okay, added something from me, and I'm gonna tell you exactly what I added in order this question to become a useful question. Otherwise, it's gonna be just information. Okay, let's go back to here. Delete this one and enter the new question now. It's gonna look like this. I need a little bit more space on the top. Now the question here will be, Again, the same information. However, now we're running periodic system. And as you remember in the periodic inventory system, we count the inventory in the beginning. Usually we count it at the end of the period. So the previous end of the period when we count it, we have the beginning balance of $500 and ending balance of the inventory after the inventory count was for $450. Why do we need this? Because otherwise we won't be able to get the cost of goods sold. We need something more here in order to be realistic. We need the purchases as well. That will be the last piece of the puzzle. We need the purchases. So let me add the purchases. Let me see what we're chasing as a goal here. Our purchases for $1,000. We purchase inventory for 1,000. Okay. I add the last piece of the question. So now I can copy this question and post it to you. Sorry about this, but this is improvisation in the real time. It takes a little bit consideration in order to be practical. Otherwise, it's not gonna work. Here we go. I have the question now. Now we can calculate everything. In this system, in this periodic system, we're using periodic system. We need the beginning balance of the inventory, ending balance of the inventory, after the count for, and the purchase is $1,000. So now let's start doing the journal entries. First thing first. Again, on April 1st, we're gonna do debit accounts receivables for $2,000. And then we're gonna have credit sales revenue with $2,000. And that's about it. Since we're running periodic system, we don't know how much cost of goods sold is. That's the only entry that we're gonna do. Next thing, what we're gonna do, we're gonna get the return. On April, fourth, we're gonna give the client a return and allowance for $500, debit sales return and allowance with $500, and we're gonna reduce the accounts receivable, credit accounts receivables with $500. That's great. Let me delete those one. We don't need this. Next thing, on April 11, we're gonna receive the payment from the client. Now, how much the client has to pay us? Same amount that he was original, $2,000, minus the $500 that we give him as a return allowance. So that will be 2,000 minus the return allowance, 1,500. So the cash that we're gonna get is $1,470. So on April 11, we're gonna get debit cash with $1,470. Credit will be accounts receivable. We're gonna clear the accounts receivable $1,500. And the difference of $30 is gonna go debit sales discount for $30. Now, if we want to calculate our net sales in this case is going to be equal to 2,000 minus 500 return allowances minus $30 discount. Our net sales is $1,470, which matching the cash. That's sales. Now, how are we going to get the cost of goods sold? That's the big question here. How are we going to get cost of goods sold? Now, since we're running periodic system, let's pretend there's no other purchases, there's no other sales for this company for the end of the month. So at the end of the month, on April 30, we have to do the journal entry debit, cost of goods sold, credit, inventory. The question is how much? Now, what we know from the question that we know that we have inventory account. Let's bring this inventory account. Where can I bring it? I'll do it right here. Trying to figure out, or maybe here. Let's do it here. Inventory account. Let's make this T account. Inventory account, we know this is balance sheet account, has the beginning balance, has ending balance, and all those beautiful things. Normal balance is debit, so beginning balance will be on the debit side, ending balance gonna be on the debit side as well. Coming in is the purchases, going out is the cost of goods sold. Ending balance here, beginning balance here. That's our debit. On the other side is our credit. And the count is inventory or inventory. Okay, great. We have purchases for $1,000. The question says the purchases is $1,000. We have beginning balance of $500. And after count at the end of the month, we count that we have $450 even for worth inventory. The question is, how much is our cost of goods sold? Or what's the number here? So how are we going to get it? We already calculate that one. If you remember question 1, we get the beginning inventory plus the purchases it's going to give us available minus ending balance inventory is going to give us cost of goods sold. So what we have to do, we just have to change the numbers. Beginning inventory is 500, purchases 1,000, 1,500 available minus the ending balance 450. Our cost of goods sold is $1,050. That's how simple it is. So what I'm going to do on the end of the April, I'm going to plug here $1,050. So I can be, my inventory account now is in balance. So cost of goods sold here is going to be $1,050 and inventory is going to go down $1,050. I'm adjusting here. That's cost of goods sold become this amount. Now my gross margin is exactly the same, 420 or 29%. That's how we're dealing with the system, which the company that using periodic inventory system. So the periodic, we need to know the beginning balance, purchases, ending balance. Once we know those, we can do the journal entry. Otherwise, we won't be able to do it. Now let's see one. Last time I show you closing of the accounts for the periodic system. I want to show you another question with closing accounts for the periodic system. So I'm going to use this Excel spreadsheet. I'm going to build on this Excel spreadsheet. For the closing entry, last time I believe we did question 6 on the closing. Today we're going to do question 7 from the same file that's sitting on Blackboard. So for the same file that we did last week, question 6, today we're going to do question 7. I'm going to bring it on the Excel spreadsheet, so you don't have to worry where is it. Or the other option that you have is from the Excel spreadsheet, which is posted with the recording from chapter 6. You can bring that Excel spreadsheet, and then you're going to see you can copy the worksheet and work with that worksheet. That's another option. First thing first, let me make those one bigger. Second, let me post the information here and manipulate a little bit more information. Increase the size of those letters and numbers. Something which is, let's say, 18. And now we have beautiful Excel spreadsheet with all the information that we need. It's too much. So once you see a question like this, what do you have to do? First, if the question doesn't tell you, usually the question is going to tell you this company running the perpetual system or periodic system. But let's say it doesn't say anything. Once you see, now the information for this question says, selected accounts of this company have this. I'm going to paste you exactly what the question says. So what you see is not a trial balance. That's what I want you to understand. It's not a trial balance. So debit and credit doesn't have to be equal in this case. Because this is only selected accounts from the company, and usually the company using periodic system. So once you see inventory January 1st and inventory December 31st, that means this company runs periodic inventory system. The next thing that tells you periodic system: purchases, purchase discount, purchase return allowances, freight in. So what that means, we have to close all these accounts. These accounts have to disappear. Balance have to be 0. Which account we also have to close? We have to close the withdrawals. We have to close all the revenue expense accounts. So everything highlighted in green has to disappear. Plus we have to close the beginning balance and we have to open the ending balance. Those are the rules of closing accounts for the company that have merchandising company which running periodic inventory system. So first step will be closing revenue and credit balance accounts. So let's see which accounts have a credit. So the first step, let's highlight first step with, we're going to leave it with new color, blue. In the blue color, we're going to do the first step. So what account we have to close? I have to close the sales revenue account first. And then I have to see which accounts also have credit balance. And I have, from the accounts that I have to close, sales purchase discount and purchase return allowances also have a credit balance. So with the first entry, I have to close the revenue plus those two accounts. When I'm closing them into the income summary account. So as we can see, the balance right now is credit. I want the balance to be 0. In that case, I have to debit those accounts. Every account that has credit balance, I want to bring it to zero. I have to put the same amount on the debit side and the balance is zero. So what we're gonna do? Debit. First, we're gonna debit sales to revenue account. Then I'm gonna debit purchase discount account. And then I'm gonna debit purchase return and allowance account. My sales revenue account has $17,000 to be closed. My purchase discount has 300 and purchase return allowances has $1,400. You didn't say anything. So what I'm gonna do now, I'm gonna save this document. And again, I'm gonna close it, I'm gonna flip it back to you. So let me close this one, save. Go to the chat room here. And in the chat, once I'm in the chat, I'm gonna share the file with you again and send. And let's start working. Continue together with this adventure. Now let me know if you are where I am. In the chat, let me know if you are where I am. Are you the same level with me? Excellent. Now let's go. Which account we're gonna create now? If you are with me, which account we're gonna create? We already closed sales revenue. We closed the purchase discount. We closed the purchase return allowances. Where I'm gonna close it? And which account I have to create now? Why question mark? Because you don't know, or because you're guessing, or because you're afraid to say it? Why is the question mark there? That would be my only question. Income summary. Why are you guessing? If you tell me that you're guessing, then I have to go and check how you did on your midterm exam. And if you didn't do well, I have to go back and show you how it's done. If you did well, then I'm gonna ask you how did you be able to do it on the midterm exam and still wondering which account to close. Which one will be scenario 1 or scenario 2? Let's go with credit now. Or somebody did the midterm for you. Which one is it? You did well. That means somebody did the midterm exam for you. You can redo it. Me too. But technically, I'm doing it every time when I'm with you. So there shouldn't be question marks. Let's go. Income summary. income summary, and how much will be the income summary here? Will be sum of all these numbers. So 18,700, we're done. First step is done. Let's go with the next step. Let's highlight this one here with blue as well. And let's go with the step 2. In step 2, what color we want? We're gonna close withdrawal later. Leave it. Let's leave it for now the withdrawals. Let's close second. Closing, expenses, and debit balance accounts. Which is our expenses? This is our expense, correct? So we have to close this account. Plus I have to close this sales return and this sales discount and sales return allowances. Plus I have to close the purchases and freighting account, which I forgot to close it today during the live lecture. We're not going to close the capital because if we close the capital, that means we're closing the company. So, at this point, we're not closing the company yet, right? So let's leave the company. Let's focus on second stage, which is closing the expenses and then debit balances, which including sales discount, sales return allowances, and purchases and freighting, which has to be with zero balance at the end of the period. So let's start. First, we're gonna debit income summary. Account, we're gonna see which amount, and let's start creating now. First, I'm gonna credit accounts fee expenses. Then I'm gonna credit sales discounts. Then I'm gonna credit sales return allowances. Then I'm gonna credit purchases. And the last thing that I'm gonna credit is the freighting. Okay, let's go one after another. Accounting expenses 1,000. Discount 140. Return allowances 2,000. Purchases 26,500. Oops. Purchases. Let's bring these purchases back here because we need them. Purchases 26,500, and the last one is the freighting 1,200. So once I end up everything in the income summary, we should have the amount of $3,840. Excellent. Let's keep going. Number 3. Step number 3. Now we have to first close the beginning inventory balance and open the ending inventory balance. So in step 3, I'm going to highlight it in that kind of color. First, we're going to close beginning balance of the inventory, and then we're going to open ending balance of the inventory. So the beginning balance of the inventory, as you can see, is debit. I want to bring it to zero. So what do I have to do? I have to credit it. So if I credit it, I have to debit something. I have to debit income summary. And I have to debit income summary with $500. And I'm going to credit. I'm going to create my inventory on January 1st with the same amount, $500. Then I have to open the beginning balance of the inventory. Let me find another color to highlight it a little bit darker. So how I'm going to do this? Debit inventory December 31st, and the amount there is 16,000. And I'm going to create income summary with $16,000. After I do this, we're going to go to stage number 4. In stage number 4, what we have to do is close the income summary. Where are we going to close it now? We're going to close it into the owner's capital. But first, let's open this income summary account and let's see what's in it. Income summary doesn't have beginning balance, doesn't have ending balance, it's purely cumulative account, which at the end of the period has to disappear. That's the beauty of this account. It stays only once the period is active. Once the period is gone, this account, actually we're creating it only at the end of the closing entries, and after that has to disappear. What we have in this income summary account? Let's start shopping now. I'm gonna move it a little bit higher right here. And let's see, from the first entry, I have amount of $18,700. From the second entry, I have amount of $30,840. From the third entry, I have on both sides, first I have $500 on the debit side, and then I have $16,000 on the credit side. That's my debit, that's my credit. So if I have to do the calculation on the income summary, what will be my credit balance? First, which balance I want to be higher, debit or credit? On the income summary account, where do I want to see the balance, on debit side or credit side? On the debit side. So what's on the debit side? On the debit side are expenses. What's on the credit side? Sales. So what do you want? Which one do you want to be higher? Sales or expenses? Sales. So where do you want the balance to be? On the debit side or credit side? On the credit side. Make sense? What's going to happen if the balance is on the debit side? What's going to happen if the balance is on the credit side? No gain, profit, or net income. Okay? So where is currently the balance? After we do the calculation, the balance is going to be this one minus this one. The balance is going to be 3,360 credit. How can I close it? By debiting the same amount. And now I'm going to highlight it in red so you not miss it. So let's close it. Debit. Income summary with the amount that we already established, $3,360. Which account I'm going to create now? Owner's equity. Capital. Let's give it to capital, owner's capital. 360. Excellent. What's the last account that left? We have one account left, withdrawals. Let's close this the withdrawals, number 5. I'm gonna leave it in the same color now. Not gonna change any colors. Why didn't do it? Let's try again. Number 5 will be you know what? I'm just gonna get the green cover and gonna forget about everything else. Let me see if I can get the right green cover. I believe not this one, not this one, this one. Closing. Withdraw. Debit. Where is the withdrawal account? Debit or credit balance? With debit balance, so we have to close it on the credit side. So we're gonna debit capital. Thank you. Capital with $2,000, correct? $2,000, and we're gonna credit. Which account we're gonna create? The one that we're closing, withdrawals, with $2,000. So at this point, can we see what's happened with the owner's capital account? Let's use this one, owner. Now, owner's capital account has a beginning balance, has the ending balance. And the normal balance is credit, beginning balance and ending balance. If you end up ending balance on the debit side, that means owner owes money to the company. So what was the beginning balance? Beginning balance was $14,700. What's happened with this account? What's come in and what's went out? Let's see. First thing first, we can see from the income summary, we adding $3,360. From the withdrawal, we deducting $2,000. So what's the ending balance of this account? It's gonna be the beginning balance plus the credits minus the debit. So the ending balance of the owner's capital account is $16,060. Make sense? Awesome. Okay, that's with the purchases, sales, closing entry, periodic, perpetual system. Let's move now to more interesting questions, which are most likely questions like this, calculating the ending balance, cost of goods sold, when we're having periodic and perpetual system. So now I'm going to go very selective on the questions, and I'm going to choose questions starting with something easy and moving to something more difficult. Let me delete this one. I don't need this one. I already have it. I want something like this. So let me choose which question I'm gonna show you. Give me a second. Those questions are under chapter 6, the one that I'm gonna show you. Those are under chapter 6. So I'm gonna go again, very selective questions. I'm gonna start with something simple and we're gonna move forward to something more challenging. However, I'm gonna start with periodic system. I have to tell you, I'm gonna start purposely with periodic system. Why the periodic system? Because periodic system is the one that I'm gonna test you first. And second is because periodic system, for the first in, first out, it's gonna give you the same result under the perpetual and periodic system. So there will be no difference on the first in, first out between the both systems. Okay, I found the question and let's do the calculations. Gonna delete this one and I'm gonna pause this question right here. Okay, all this calculation, I don't need it now. There will be no debit and credit, so we're moving out of the debit and credit, no more debit and credit. So what we calculate, we're gonna calculate the ending inventory using first in, first out and weighted average. Before we do that, what do we need? We need to make our one schedule. What is the schedule? The schedule is that we already made it here. This is our schedule. And the schedule is very simple. I'm gonna post it right here. Beginning inventory plus the purchases gonna give us available. Less the inventory is gonna give a cost of goods sold. If we have to find out cost of goods sold, we need to find ending inventory, then we can get the cost of goods sold. If you want to find the ending inventory, find the cost of goods sold, get the ending inventory. By knowing that ending inventory, cost of goods sold, is gonna give you the value. It's gonna be together, gonna be available. So let's go. First, what do we know? We know that beginning balance, we have beginning balance, which beginning balance is expressed as a number of units and cost per unit. As we can see, we have two things, number of units and cost per unit. And I'm gonna push this one a little bit further, not that way, the other way. Number of units and cost per unit. And that's after that, once I get this, I'm gonna have total cost. So at this point, what I'm gonna do is probably you can guess what I'm gonna do. I'm gonna save this one. And I'm gonna post it to you. That's question 11. I'm gonna close it here, save it, close it, and I'm gonna share it with you. So you can start working with me. Okay, now you have it. Now I know you have it. And I'm gonna open it again on my screen. And I'm gonna share my screen and we can go with the calculation. So beginning balance, we have the beginning balance. We have the unit cost, we have the total cost. Those are our columns. Now we have to fill the information. Beginning balance, how many units we have in the beginning inventory? 100 units. Let's put those numbers, 100 units. What's the unit cost? $10. Now you can put here the $10 as a dollar amount. And the total cost obviously will be 100 times 10, $1,000. That's our beginning inventory. What we have after? We have two purchases. Let's go purchase 1, and purchase 2. Correct? Purchase 1, what we purchase? We purchase 40 units. What's the cost per unit? $12. What's the total cost? $40 times 12, 480. Purchase 2, 20 units. Cost per unit? 20. No, 14. Thank you, Yuriko. So the total will be 280. Now, we're done with the beginning balance. We add the purchases, what we can get available. As a number of units, how many units we have available? What's the cost of those 660 units available? Total cost. Can you see it? $1,760. This is the key calculation here. So now what that means? That means that beginning balance and ending balance together is going to be equal to $1,760. It doesn't matter which method we're going to use. The beginning balance plus the cost of goods sold has to be equal 1,760 because that's what we have available. From those we have to sell and something is going to stay. What is our ending inventory? How much left? How many units left? Can you guys see it? 30 units. We don't know the cost, right? So that's why we need either of those methods. First in, first out weighted average. At this point, can you tell me how many units we sold? We sold 160 minus 30. 130 units sold. So now the question is, what's the ending balance? What's the cost of goods sold? Who's going to be here? That's what we're chasing. So now, this is our starting point. I'm going to copy this and I'm going to move it here. And here we're going to use first in, first out method. There are two options here. Since I know the available and since I know the ending balance. There are two options here. Actually, I also know how much I sold. We have to find the cost of those 30 units. That's all we have to do. We saw, again, there are two options. Again, I'm going to repeat myself for third time, but there are two options here. I'm going to insert one right here, row like this. And I'm going to move one more row on the left. On the right, actually, it's going to leave it like this. I'm purposely doing this because I wanted to show you the options. First one, I know that I sold 130 units. Which units I sold? Obviously, I sold, let's here, if we having sold, I sold those 100 units, and then from those 40, I sold 30 units, correct? This is what I sold. The other option is, I can go with the ending balance. What's left? I have 30 units. Okay, the 20 units coming from the last purchase and 10 units coming from the purchase one, correct? That's another option that I have. So I can either work with the ending balance, either I can work with the cost of goods sold or the units that I sold. Both's gonna bring me to the same conclusion that I have left 10 units from the first purchase and 20 units from the last purchase. Here, I have 10 units from the first purchase, 20 units from the second purchase. So the question is, what's the balance of my ending inventory? So I have 10 units at $12 and I have 20 units at $14, correct? From purchase one, and that's really from purchase two. That will be equal to 10 times 112, that's 120. The other one is 800. So can you tell me how much is my total balance and imbalance? I have 30 units. And how much is the cost? 400. So here I have 400. Now, if this is 400 comes from this calculation, the question is, how much is the cost of goods sold? Now, can you tell me now how much is the cost of goods sold? Available minus ending balance, cost of goods sold. Does this make sense? That's first in, first out. Now what we have to do? Now we have to do weighted average. For the weighted average, let's go here. Weighted average. For the weighted average, what I have to do, pretty much the same story, just repeating the information, but different color. So we can keep it on the different level. Still working with the same information. What will be different though? I don't need those units. What I'm selling, what's left, I don't need this information. I can delete this one. I don't need, those numbers are irrelevant. So what I have available from units available, I have 160 and the total cost is 1,760. Once I know that, can you tell me what's my average price per unit? Average price per unit will be this one divided by 160, $11. So how much is the cost of my ending inventory? Per unit. Ending inventory per unit. Not in total, per unit. $11. How much is per unit is my cost for the single unit that I'm selling? 11 units, correct? $11. So at this point, can I calculate the ending balance? It's gonna be 30 times 11. Once I get the ending balance, I can easily give you cost of goods sold. This one minus this one. Now, when you don't have round numbers, usually you're not calculating you're not showing the cost of goods sold cost for per single unit. You're just manually calculating because you have available minus the ending balance gonna give you cost of goods sold. Make sense? So in that case, tell me which one is easier, weighted average on the periodic or first in first out on the periodic? Which one is the easiest one? Which one is easy for you? First in first out or weighted average? Between the weighted average and the periodic and first in first out, which one is easy for you? Yeah, for me, weighted average is easier because once you have the total cost and total units, you just divide it, get the cost, and boom, done. Now, let's see what's the difference between one method and another method. What we're gonna have in both methods, once we run all the calculation, we're gonna have sales, we're gonna have cost of goods sold, and then we're gonna have gross margin, correct? This is our calculation. And here we're gonna have exactly the same. Now the question is, in which scenario between weighted average and first in, first out is gonna give us higher gross margin? Here I'm gonna have cost of goods sold 1,360. In the other method, I'm going to have 1,430. Where my gross margin will be higher? And which scenario? On the weighted average or first in, first out? Let's put it side by side so you can see it. Mm, Which one I can use? I can use this one. That's my first met. That's my second. This is your first in, first out. This is weighted average. Which one is going to produce the highest gross margin and highest operating income? Why the first in, first out is higher? Why will be higher? Because the cheapest go sold first. Thank you, Yuri. Even I cannot say it better. So in our inventory, what stays in our inventory? Expensive inventory. When the weighted average, the balance is weighted. So we have in our cost of goods sold some of the highest price and the lowest price, but average is $11. Which one you prefer, first in, first out, or weighted average? If you have to choose as a manager. Or you can say we are not managers yet, so don't ask us questions which are tricky questions. Okay, let's move on. Let's do another question with this first in, first out. How do you feel about this first in, first out? Okay, let's do one more question. Let me see which question I choose today. I'm trying to repeat the same question. So the people who from the morning class who they're watching this video, they can see exactly the same questions. Yes, I know which the question is. So this company, let me flip it here to the Excel spreadsheet. This company provided the following information for August. In this case, we even have the calculations available. When you see questions like this, you should fly on questions like this, which have all the available information already given to you. What is required? Let me post it here. What's required? That's not what I wanted. Required. Hey, let me do some formatting here on the Excel. Just give me a second. Once I copy and paste those one, I can get rid of this formatting. Okay, almost there. Somewhere I'm lost the beginning of the sentences. Interesting. Uh-huh. Okay, that's what we have to do. With this question, we have to get all those answers, which are, what's the value of the ending inventory assuming the company using periodic inventory system and weighted average? What's the cost of goods sold company using perpetual inventory system first in first out method? And what's the cost of goods sold if the company using perpetual inventory system and weighted average method of valuing the inventory? So the good thing is we have all the calculations available. What we have to do? We have to transpond the information. What we need? We need the beginning balance, number of units again. Let me go back to the number of units. Gonna delete all this thing and we're gonna start from scratch. So we need the beginning balance, which we have beginning balance. Our beginning balance is 40 units. Hold on a second. Let me save this one and give it to you, correct? And then we can work together. Let's delete this one. We're gonna add a new one. Or do you want me to leave this information? You just update it. Gonna leave you then this information, and then you can update it during the once I start updating it, you can update it with me. So let me save this Excel spreadsheet and share it with you again. Okay, you have now the Excel spreadsheet. And let's start working together. What we have first? We have the units. Opening inventory is 4 units. Unit cost is $30. Total cost is already given to us. 30 times 40 times 30, 1,200. So let me share my screen. Here we go. Then we're going to have the first purchase. In the first purchase, we purchase 60 units at cost of, let's enter those one. Cost is $35. Total cost, not that much, $2,100. Next one, we have 90 units purchase. with $40 per unit. Total cost is 90 times $40. That's $3,600. So in total, how many units we have? 190 units. What's the total cost for those 190 units? Now, as you can see, here we don't have the ending balance. So the ending balance is missing. But what we need, we have our sales. For the cost of goods sold, how many units we sold? We sold 100 plus 70. We saw this 100 plus the 70. We had 170. How much is our ending balance? 20. Having in mind this calculation, let's go to the next sheet. In the next sheet, what you have to do? The first in, first out. You just have to manipulate the numbers. How many left? 20 left. How many we sold? 170 sold. Okay, which one we sold? Did we sold the first 40? 40 gone. Did we sold the next 60? 60 gone. We are 100. From the 90, how many we sold? 70. How many left? 20. The 20, let's go the opposite way. From the 20 ending inventory, which inventory stays with us? The very last one, correct? Do we have 20 units from the last purchase? Yes, we do. So that's where we are. Make sense? Again, you can go one way or you can go the other way. Anyway, you're going to get the same result. What do we need to have? Only the unit cost. See, unit cost is here. So what's my balance of the ending inventory? I have only 20 units, correct? And what's the cost of those 20 units? Since they're coming from the last purchase, how much is that cost? $40. So what that makes out my ending inventory? $800. That will be equal to $800. So how much is my cost of goods sold under the first in, first out? Excellent. Now let's move to the weighted average. What do we need? Number of the units again. Let's copy the number of units. We have 190 units available. Cost. We have the cost. Now the question is, What's the weighted average cost per unit? This one divided by 190, 36, 32. How many units we have on the ending inventory? 20. Correct? And how many left? 7. 107. So how much is our cost of goods sold in this case? 6,173. Ending balance is this one. Okay, you can go with 40. Yes, totally okay with 40. If you want, you can round it on 36 even. Totally fine. Now, when you're doing your questions in Pearson, be careful with the roundings. Now, let's see the sales. How much are our sales? Our sales are $10,900. Can you see it? This is my sale, and this is my sale. If I get together the sales, I have 10,900. Let's see the calculation here. 10,900 are my sales. It doesn't matter which system you're going to use, the sales is going to be the same. The sales not going to change. What's going to change? Cost of goods sold. Now, under first in, first out, how much is our cost of goods sold? We calculate 6,100, correct? Which give us gross margin of this one minus this one. We have gross margin for 4,800. As a percentage, this one is equal to 44%. On the weighted average, our cost of goods sold are that much. So, which give us gross margin of 43%. So now we can see that under the weighted average, we're generating lower gross margin, which means our net income is going to be lower. What's the conclusion that we can make after this? Is when the cost of the purchase of the inventory goes up, first in, first out, always going to tend to give us higher net income. Why? Because keeping in the inventory the last purchases, which are the most expensive. With the weighted average, the inventory is going to be lower, but the net income also is going to be lower. And it's going to be more steady. Those are the questions that I wanted to do with you today. Now, so at this point, since you have all the Excel spreadsheet, let me save it one more time, close it, and give it to you. And you have now the final version of Excel, which I'm going to post later with the recording on Blackboard. And that's where I'm going to stop with this. And at this point, I'm going to give you a little bit introduction about chapter 7. Obviously, we won't be able to cover anything from chapter 7, but at least I want you to start it, so both sections to be exactly on the same level. Okay, I have it open. And let's quickly give you some introduction of this chapter. The chapter is very light. Chapter 7 is very light chapter. So my plan is next time to finish this chapter and start with the cash and see how it goes. Technically, we have 3 more classes today and 3 more. And we have this chapter and 2 more chapters to cover, which we're going to cover it, plus the final exam review. So let's go with chapter 7 very quickly. Again, I'm just gonna start in the beginning and gonna stop at some point. Chapter 7 is about accounting information systems. And why do we need that information system? Obviously, we need that information system to keep all the data on the same place. What will be the data that we want? We want the data about the sales in terms of sales purchase, customers information, how much the customer purchased, when he purchased, was the highest customers who buying from us the most, how much is the outstanding balance, where is the next shipment, how much the customer owes us, how much the total cash that we receive from the customer. That's for the sales. For the purchases, we want to know the vendors, quality of the material, how much material we're purchasing, what's the cost of the material, what's the standing balance. If we have to pay, did we pay everything? What's the outstanding balance? What's the vendor's information or supplier information? For the payroll, same thing. We want to know about average employee, collecting the time records for the average employee, process it in the payroll, transfer everything to our if we're doing service company, which will bill for hours for our employee, we want those hours so we can charge it to the client. And the accounting information system should give us all this information. What's the quality of the effective system? The effective system should have control, has to be able to make a comparison, has to be flexible, reports, produce the reports which meets our needs, and has to have a favorable cost benefit relation, means the benefits that we're getting from the system has to be more than what we're paying for the system. Futures. Again, let's go with the first one. Control. We need to control who entered the information, how we're using the information, how we applying the management policy, how we safeguarding the assets and records. Has to system to prevent of errors and fraud. Have to provide the security with the limited access and make sure that the information which is in the system is relevant and is accurate, is entered on the daily basis. Comparability. What makes the system comparable? When the system work easy for the business operation, for the people, for organizational structure, for all those purposes, we need the system to produce the information which can be comparable period to period. Flexible. What means accounting software to be flexible? Means that if the company changes the accounting software to be able to evolve with the business, and we don't have to purchase new accounting software. So once we get one accounting software, even if we change the business, we're still gonna rely on the same system. And the system needs to accommodate the changes if we're doing any changes in the business. Reports. Reports has to meet what we want. means the system always going to give you some reports, but usually those are not reports that we want. We want something else in relation to our current needs. For that reason, the system has to be flexible and adjustable to the customer needs, not the customer to adjust to the system, but the system to adjust to the customers. That's one of the sales reps on the accounting software usually tells you that can a system adjust to my company? They tell you yes, 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 everything's fine, everything's fine. We have here a team of highly trained specialists which going to help you. Okay, you're buying the system and after that you're stuck. Why? Because those highly trained specialists turn out that they don't know how to. They don't try to make effort to understand your business, and second, if they cannot fix something, they say, well, why don't you change your business to adjust to the system, which makes system very unuser friendly or user unfriendly. Unfavorable cost benefit relationship, always you have to look for the benefits and cost. If the costs are more than the benefits, then this system probably it's not appropriate. If the benefits is more than the cost, then yes. Which is the component of the computerized accounting system? We have two things. We have the hardware and we have the software. The hardware is the network system, electronic equipment, computer system, network links, anything like that. Software is the program that drives the computer. So we always have the hardware and we have the software. We can have the cloud computing, which helps us to pay the third party on their server. We're going to have the people who work on the system. They're operating properly. They must be properly trained. Sometimes they're not, but must be properly trained. And this is very crucial for the success of the accounting software and the information that accounting software producing. How the accounting system work? First, we're going to have input. Then we're going to have a process which taking the input, analyze the data, put it in the right accounts, and then we're going to have output informs the report. Input is going to come from the source documents, from the purchase orders, from the invoices, sales invoices, purchase invoices, bank deposit slips, everything. And that information has to go inside the accounting system. Once we have the posted inside the accounting system, then the system, once it's organized properly with the proper accounts, with the proper accounts payable, proper accounts receivable, proper customers, proper vendors, nice flow from one module to another module, we're going to see the accounting system have different modules. That's going to help us to generalize, to post, and prepare the financial statements. Outputs will be form of the report. So how the system's going to work? We're going to have the accounts. We already know the assets start with 1. Liability start with 2. Owner's equity start with 3. Sales 4. Expenses 5, 6, 7, 8. Now, if we take a look at the assets, what we're going to see is number 1 is asset. Then we're going to have 11 is the current asset. 15 is the property, plant, and equipment. 18 is the other assets. Now, 11.1 is going to be, or 101, is going to be cash. Accounts receivable will be, since it's the current asset, is 1, another number 5, accounts receivables. Under the accounts receivables, we're going to keep track of every single customer that we're dealing with. Why we need that? Because we need information for each of those people. So the system itself is going to look like this. We're going to have a 1, 2, 3, 4, 5 modules. Generally, that's what we have. One module is going to deal only with the sales. Next module will be cash receipt journal. In the cash receipt journal, every time when the cash is received from the client, it's going to go to this journal. Then we're going to have the purchase journal and cash payment journal. And then we're going to have the general journal. So what we're going to record in which journal? In the sales journal, again, we're going to record only the credit sales. In the cash receipt journal, we're going to record only the cash receipts. Purchase journal, we're going to record the credit purchases. Cash payment, we're going to show all the payment of the cash. And any other transaction which is not cash of any of those journals going to go to the general journal. Now, for the accounting system, we have another terminology, which is called Enterprise Resource Planning System, which is the Enterprise Resource Planning System, or ERP system. That's a software which holding all the company data on one place, which have information not only about the accounting, but also for the sales, purchases, purchase receipts, purchase orders, invoices, payments, run the checks, run the information, run the reports for different purposes, different reports. And what's the advantages of this system is, since all the information is in one place, you can use it only one system. You don't have to purchase 5, 6 systems to you to have a duplication of the information in your site. However, it's very heavy. And this software, you have to have person in place, he to understand the software and he to work very well with software. Plus, he needs to know very well the accounting. And then everything is going to start falling on the right places. So that's another opportunity for those of you who's going to continue with accounting. I know there's not many people here today. So for those of you who are here, listen to me carefully. The way the things are going, the future accountants, they will need to know about the software in terms of the accounting systems. IT specialists, they have no idea about accounting. IT specialists cannot create accounting system. He cannot maintain the accounting system because the only thing that they know is how to write a software. They don't understand anything about accounting, which gives you opportunity. Once you finish accounting, you can specialize only on the implementation of the accounting softwares. And usually the company which selling accounting softwares or enterprise resource planning system, they're looking for the professionals, accountants, to help them to implement that system. Because the accountant can see the whole process in the entire company. From the management accounting, for the financial reporting, for the reports, how to prepare the different statements, how can we use the data, how to adjust the system to the needs of the clients. So that's one big opportunity for those of you who are going to continue with accounting in the future. So how are we going to journalize and post those transactions? Very simple. Watch this. Sales If we have sales on account, actually, that's not entirely true because any sales, including cash, if we want to have information about the customer, you're gonna put it on the sales journal. Any cash that you're gonna receive, you're gonna put it in the cash receipt journal. Every time when you purchase, you're gonna put it on the purchase journal. Every time when you pay, you're gonna put it on the cash payment journal. For any other entries, you're gonna use the general journal. So once you open accounting software, that's why you're gonna see purchase account, purchase journal, which is dealing only with accounts payable, collecting the information, purchases, how much you have to pay. And from there, you have the cash payment because you have to pay for whatever you purchase. Then you're going to have sales journal or accounts receivable journal, which you're collecting information for everybody to whom you're selling, how much they owe you. And every time when you collect the cash, you're clearing accounts receivables or reducing the amount that people owe you. For everything else, you're going to use this general journal. What will be everything else? Depreciation, some adjusting entries at the end of the period, something like it's not related to the purchase or sales or cash payment or cash receipts is going to go with the general journal. So if we have a bank deposit, that will be cash receipt. Going to go to cash receipt journal and you're going to update accounts receivables. If we have the sales invoice, you're going to go to the sales journal, which is going to update the accounts receivables, and you're going to update the inventory. And you're going to go with the general ledger. All those going to the general ledger at the end of the period. Oh. Then we're going to have purchase. Purchase is going to be involving on the purchase journal. In the purchase journal is going to update the inventory and accounts payables. Once we paying, the payment's going to update accounts payable. We're going to clear the accounts payable. Payroll is payroll, directly goes to the general ledger. Anything else is going to go to general journal. And from the general journal, you're going to prepare the financial statements and any reports that the people may need. Next time, we're going to see how the sales journal works and how the cash receipt journal works, how the purchase journal works, and how the cash payment journal works. This is the choosing the proper how we're going to choose and what we're going to choose and how to identify the transactions. Once you see the transaction, you're going to ask, is there cash involved or not? Are you paying or you receiving? I'm neither paying cash, neither receiving cash. Then the answer is no. So then you're going to ask yourself, is the transaction which is not involving cash now is related to the purchase or sales? So first you're gonna, is the transaction sales on account? If it's yes, sales journal. If it's not, that means it's purchase. Then you're going to purchase journal. When you go there, you're gonna ask yourself a question: is this purchase on account? If it's yes, purchase journal. If it's not, general journal. If the transaction involves cash, then you're gonna ask, am I receiving cash or not? If it's yes, cash received journal. If it's not, cash payment journal. That's some kind of logical way you to identify way to record the transaction. Again, start with, is it involve cash? Yes. Okay, what cash? Coming in, coming out. If it's coming in, cash receipt. If it's going out, payment. If it's not involving cash, then we have to find out, is it sales or is it purchase? If it's sales on account, sales journal. If it's purchase on account, purchase journal. If it's something else, general journal. Next time, the only thing that left from this chapter is to show you how we're gonna do this sales journal and how the information from the sales journal going directly to the general ledger account for the sales, for the cash receipts, for the purchases, and for the payments. And that's all about it. Again, the chapter is very light, explaining the accounting software and accounting information system. So I don't expect you to have problem with this. And the questions which are related to this chapter are limited to only to the if you have certain transaction on which journal you're gonna post it. That's where the questions are. If you have this, on which of those journal you're gonna post it. If you receive the cash from the customer, where you gonna post it. Those will be the questions here. And that's where I'm gonna stop for today. Yes, now for the chapter 5 and 6, again, what I want you, the way I want you to think is purchasing and selling, purchasing, selling, purchasing, selling. What's going to happen in purchase? In purchase, either perpetual, either periodic. If you have perpetual, everything goes to the inventory. If you have periodic, play with different accounts. Purchase goes to purchase discount goes to purchase discount, purchase allowance goes to purchase allowance, freight goes to freight. After you open those accounts, close them. Sales. You're going to have sales, but they're always going to be sales return allowances, sales discounts. We have separate accounts. For that reason, periodic and perpetual, there are no changes. Now, on the periodic and perpetual, the main thing that you have to remember is on the periodic, we don't have to do cost of goods sold inventory adjustment after every sale. Why? Because we don't know. The system doesn't tell us. When we're going to do? At the end of the period, when we count the ending inventory, we're going to see how much left, come up with the cost of goods sold, done. On the other hand, on the perpetual, every time when you do the sale, you can calculate the cost of goods sold. System give it to you, make the journal entry. That's why I'm not planning to test you too much on the periodic system, perpetual system. Why? Because the accounting software is going to do it for you. I want you to understand the logic, but I don't need you to do the main calculation. Once you know the logic, that's good enough for me. But for the periodic system, you might end up working as an accountant in company which for some reason they're not using that kind of system. So you should be able to pick up fast and get the results done by knowing that beginning balance plus the purchases available. From available, you have two options. Either gonna sell it, either you're gonna stay in the ending balance. End of the story. So once from available, you're gonna have two numbers. Whatever the available is, that should be equal to ending balance plus cost of goods sold. Means ending balance is available minus cost of goods sold. Cost of goods sold is available minus the ending balance. Now, how are you going to get the ending balance first in, first out from the last purchases left or weighted average? That's just matter of math. But on the weighted average on the periodic system, you're getting all the purchases during the month, entire cost to the month, for the month, simple average at the end of the month, assign that one to the ending inventory, calculate the cost of goods sold. Have a nice day. It seems confusing, but at the end of the day, it's not that. Okay. Enjoy the rest of your evening. Have a great weekend, and we're gonna hear each other next Monday.